Welcome back to the channel. I'm Foreman, and in this video I'm going to show you how many shares of a stock that you would need to get £1,000 a month in dividend income. After all, isn't it the dream to live completely off of your investments? And it's even better to know that your companies or your investments are paying you, knowing that you can earn money effectively in your sleep. So today I'm going to be talking about 4 different UK stocks that are all very popular. I'm going to highlight the 4 stocks that you could be buying, how many shares you would need, and how much this would cost overall. But also, I'm going to talk about some concerns that one may have when they're looking to invest in dividend stocks and what to really look out for as to be cautious. And so if you like the video, please hit one of these to help support the channel, and why not, if you're there, click the subscribe button if you've not done so already. Starting off the list, we have a very popular bank in the UK. In fact, probably the most popular bank in the UK, full stop, and this is because they are only exposed in this region. This stock is Lloyds Banking Group. Obviously, you would have likely have heard of this before if you're seeing this video. And right now, as of recording, the dividend yield is supposedly 2.52%. I am on dividend data, by the way, so if you are wondering, there will be links in the description so you can check out this webpage for yourself, and you could explore the FTSE 100 and FTSE 250 markets to see what the kind of dividend yields are. Where this may be a bit off in this video is that this is quite an unusually low yield for Lloyds Banking Group. If we go back 5 years, obviously the yield was quite a bit higher. This was cut during March 2020, and so obviously it makes sense, but it was sitting around 4 or 5% in between 2018 and 2019. I believe from memory that Lloyds Banking Group were going to move to a quarterly dividend. So whilst at the moment it says they've got a final and interim dividend payment, meaning they're paying biannually, they may then transition this to quarterly as the year moves on, because September and May are a quarter apart, and so this would make a lot of sense to me. So to calculate how many shares of Lloyds we would need, I simply put 1 million or 1.2 million. I divide that by the total dividends of a share, which is 1.24 pence. Note that I've put 1.2 million. This is because this is how many pennies are in £12,000, because annoyingly UK stocks are typically in GBX. So you may be wondering, how is Games Workshop worth 9,786 GBX? What does that mean? That is so expensive. Is that 90? It gets confusing, right? In reality, it is just in pounds. But to save the conversion, I've done that right at the end just to eliminate confusion. So 1,200,000 divided by 1.24. This equals 967,742 shares. That is how many shares of Lloyds Bank that you would need to own. Please be aware that there will be some rounding as this goes on, and so it's not going to be an exact figure. The calculations themselves, I didn't round, but for the simplicity of this video and what I'm saying, I did. So we then put 967,742 shares. We multiply that by the current share price, which is 49 pence or 49.28 pence. And that gives us a total cost, once we divide by 100 to convert back into pounds, of £476,903. That is how much capital that you would need to invest in Lloyds Banking Group at the moment, assuming that they don't pay a quarterly dividend and the yield stays at 2.52%, in order to get £1,000 a month in that dividend income, or overall £12,000 a year. Although this could be one to watch out for, because this was a banking stock after all, and what had happened is that the Bank of England suggested very strongly that the banks, insurers, financial companies should suspend their dividends, and so during 2020 they very much did so. So do keep in mind that whilst yes, they did try and recover and grow their dividend from 2015 onwards, that actually it didn't really get far, and from 2019 then to 2020 it was on a decline, suggesting that you might want to do some more due diligence on a stock and not only invest purely for dividend yield. And that is a very important lesson that I'm going to continue to talk about as we move on. The next stock on the list is another very popular stock in the UK, one that I've one that I went against and perhaps I was wrong for. This stock is BP, or British Petroleum. You can see in the last year the dividend yield was far higher, although they have actually cut their dividend very recently, hence why the dividend yield on dividend data is 4.59% and it's in red. BP is quite annoying here because they pay their dividend in US dollars, and unfortunately on the website the conversion is really weird because they've kept the dividend price itself in US dollars, but kept the current share price in pence, meaning there's a bit more conversions to do. I just didn't take the exchange rate into account from here, and what I did is I just chucked it into a USD to GBP converter and just saved the headache of even trying to attempt the maths at all. This is a quarterly dividend payer, paying in December, September, June and March roughly each year, and they did cut their 2020 dividend and now they are slightly growing it back. So if we look at a 5-year chart, you can see that obviously it was a much higher yield and it's certainly been pushed back a lot now. So what this converts to is 15.92 pence per share in total dividends. We multiply that by 1.2 million and we get 75,377 shares. That is how many we would need to hold to get £1,000 a month in dividend income. Then if we multiply the amount of shares by the total current share price, which is 347.80 pence, we would then, obviously convert this into pounds, need £262,161 of capital invested in BP stock to get £12,000 a year in annual dividends, with 4 payments per year and quite a consistent payer overall. This means I would need to have a portfolio of more than 11 times the size that I currently have in order to really draw off this income. And whilst £12,000 is no small sum of money to be getting passively, it's still likely not enough to cover the cost of living, especially if you've got a mortgage and other bills and even children or dependents that you would also need to pay for. And if you'd like to sign up to my stockbroker free trade, you can get a free share worth up to £200 when you use my link in the description down below. BP has also had a bit of an iffy dividend history. It was fantastic prior to 2010, but then they had their BP oil spill and obviously they had to cut their dividends as they had to really bring the money back in and fix all of the issues. They did manage to recover it fairly quickly afterwards, but then the growth was very much minimal. Although this is pretty much a kind of stock, this is already a very mature company. They're not going to be really growing the dividend by far large amounts, but it is still, or was, a consistent dividend payer, and likely from that 2020 price, it will push up slightly and it will be a consistent grower. The next stock is Legal and General. They are an insurance group, or LGen, and they focus purely on, or mainly on, life insurance and other types. They have a yield of 6.07%, and these would have been a fantastic buy if you'd have bought these in the March 2020 crash, and their yield was going as high as 12% at one point. So if you got that, well played to you. Although everything's easy now in hindsight, so I'm not saying I regret not buying more or buying at that point in time. I'm just saying that would have been fantastic for whoever did manage to get the conviction and buy the stock. Their share, or their dividend per share, is 17.82 pence. When we divide this, when we divide 1.2 million by the total dividend of these shares, it would mean that we need 67,340 shares. That is equivalent to £197,644 of capital invested to get £1,000 a month in dividend income, although this is a biannual dividend payer. Annoyingly, in the UK, as you may have seen with Lloyds earlier, although they will be going to quarterly, we can see the payment dates again are May and September. These are one of the most common payment dates, and it is quite annoying if you're trying to balance out your dividend payments over the course of a year, and so there definitely needs to be more thought into that. Although overall, I think it's better to budget your dividends than it is to buy a worse quality stock in order to make up the gap in certain months, because quite frankly, the worst quality stock is likely going to perform worse in the market, or, for instance, it could even have their dividend cut. But you can see here that Legal & General has had a fantastic run up in terms of dividend growth. The 10-year CLGR of their dividend is 13.37. It slowed down more recently in the 5 years, but that's still an impressive growth rate. But when I talk about Imperial Brands, they currently yield 8.92%. They manufacture, or they are a tobacco company, big tobacco. Obviously, there's been a lot of flack against these and past, and you know why. There's a growing emerging market, and so there is certainly potential for them to keep making capital. Imperial Brands pay a quarterly dividend. They pay 138.13 pence per share in dividends. When we divide 1.2 million by 138.13 pence, we would need 8,688 shares of Imperial Brands in order to get that dividend income, which is equivalent to having £134,525 of capital invested into this stock. This means just buy Imperial Brands. That requires the least capital. You don't need as much money to therefore get that income. That sounds like a great idea and you're sorted for life, right? Well, not exactly, and you do need to be very careful here. And quite frankly, as someone that isn't quite a dividend investor and focuses primarily on growth stocks, any dividend yield that is above 4.5%, I put a mild orange flag because I think, okay, I'm going to look into that a little bit more. And there's good reason to do this. When you look at purely the dividend, you look at Imperial Brands, hell, that is a fantastic dividend history of consistent dividend growth of 10% or more until they cut it in 2020. Again, that looks pretty good, right? And it's all easy in hindsight. But when we actually compare these companies and their share price performance, you can see that Imperial Brands in the last 5 years has really not done well at all. So you could have bought the dividend or bought Imperial Brands 5 years ago and let's see, got a yield, and you would have got a yield of roughly 4 to 5%, thinking, yeah, that's a great steal, and the yield keeps going up and up and up. The reason why the yield has gone up is because the share price has gone down. After all, if the quality of a stock was so good and there was so much value in that dividend income, for instance, then the yield would go lower because more people would be buying it, pushing the shares up. I'm not saying these stocks aren't worth buying because there are certainly moments where you could have bought these stocks and done very well. For instance, Lloyds, pretty much anywhere through 2020, you're looking at a very good amount of profit on your position. And for instance, the likes of Legal and General has done pretty well in the last year as well. So you do need to be careful and keep that in mind, especially as these shares are certainly volatile and there is always a reason as to why the dividend is high. Especially if we look at things like financial health. This will tell me the quality of their balance sheet, and we can see that basically a lot of them have debt. So obviously ignore Legal and General here because they are an insurer, they will need a lot of debt, but they'll have a lot more cash. When we look at obviously Imperial Brands, they have a 218.5% debt to equity ratio. That is a concerningly high amount of debt and a very limited amount of cash. So I try to exercise caution here because I don't think you should be buying the highest yielding stocks. You should be looking for companies, or at least I would, that with business perspective investing, that you're buying a company that is going to continually make money, grow on their money, have predictable earnings, and you can explain the kind of company this is in 5 bullet points to a 5-year-old kid, and then you're looking at a very quality investment. I do like businesses, and I believe Charlie Munger said this, that are easy to understand but hard to grow, because once they get past that initial stage, they become a very dominant business. And if they're in an industry that is very difficult to grow in, obviously they have that natural competitive advantage. I don't think I would personally be buying many of these shares that I have mentioned on this list. I personally am not after dividend income, frankly, because I don't have a capital of more than 134,000, or in the case of Lloyds, £476,000. I have nowhere near that level of capital, and whilst I'm young, I don't really have anything to spend dividend income on other than really things like discretionary spend. And so I put my focus into a portfolio of growth-only stocks. Mainly growth because I do have a dividend payer, and I focus in these growth stocks with hopes that they can compound my wealth faster for a little bit of extra volatility and a little bit of extra risk. And then over the longer term, as that wealth generates hopefully faster than the average market, I could then, as I'm getting nearing to retirement, then look to transfer that into some dividend stocks and then start to draw off an income and look for stocks that preserve your capital rather than rapidly grow it, but at least then beat inflation with the growth of the capital of the investment, but also pay you a nice and handsome dividend. So there is a lot to look out for, and you do need to be careful. If you're interested in my views in any stocks in the market, I do stock requests. There's a link in the description down below. Thank you for watching. If you're interested in my UK stocks portfolio, click the card at the top right of the video. Have a fantastic day.